everyone. Welcome to the webinar series, Infrastructure and Financing. I'm Shyamala Shukla from the PPP Group of the World Bank. The topic for today's webinar is recent global trends in infrastructure project finance. This is the third in the series on this specific topic of infrastructure and PPP financing. And today we have with us joining from Hong Kong, Gavin Munro, and from Washington, D.C., we have Clive Harris joining us. And this is a follow-on webinar from last year. If you remember, we were here last year with you, with Gavin, and we spoke about the global trends in infrastructure project finance. Specific to public-private partnerships. This was on November 11th, 2014. So we'll pick up where we left last year. And the bonus this time is that we also have Clive Harris, who is well known in MDB circles and in international development specific to PPP. And he will be talking about, the MDB side of infra financing and what do the MDBs think and what's happening overall in emerging markets and in countries, the IDA, what we call the IDA countries. He will explain more, and he will also look at the PPI database and what does it say on trends and countries. And I'll very briefly introduce both of them in terms of the work they have done so far. Clive has been with infrastructure and PPPs from the beginning of his career. It's close to 25 years. He has worked across the 6 regions that we count in the World Bank. So he's worked across all of these regions. He's worked in terms of countries. He's lived and worked in India. He knows a lot about that country. He has worked a lot in the Latin America and Caribbean. Right now, he heads the public-private partnerships group of the World Bank. So he's the face of PPP for the World Bank for us. Gavin, of course, needs no introduction. I see a lot of names from last year's webinar, and he is still the Managing Director and Head of Infrastructure Finance Asia Pacific region for Societe Generale, and he's on the corporate and investment banking side. He also has worked across, as I said, across continents. He worked in Africa. Has a very good knowledge of the African market. He's also been in London, so knows the European market very well too. And right now he concentrates on the Asia Pacific market. And Gavin, like last year, will tell us about what's happening in the major markets. So this will not be just confined to the emerging markets. It will also be, he'll also be talking about the mature markets. But we'll begin with Clive first. And before we go on to Clive, I should mention that this webinar is brought to you jointly by the Leadership Learning and Innovation Group and the Public-Private Partnerships Group. Clive, over to you.
Great, thank you very much for that introduction, Shyamala. Hello to everybody. Good morning, good afternoon, good evening, wherever you are, and thank you very much, Gavin, for joining us as well. I know it's very late where you are. We very much appreciate you sharing your insights with both World Bank staff, but also everyone else who's joining. So as Shyamala mentioned, what I will do is give really an overview of what we see happening in the private infrastructure and PPP space. It's largely based on data from the PPI database that we maintain. This is a database which now has over 6,000 projects. It covers energy, water, transport, and telecommunications. I'm not going to be covering telecommunications in this update since there's not so many public-private partnership projects in that sector, though there are some, but I'll focus on the other sectors. What I will do is give you an overview of what we see happening in emerging markets and developing economies, and then I'm going to focus my attention on the lower income countries, the IDA countries, which Shyamala mentioned, because that's probably certainly the area of greatest focus for the World Bank Group and also for the other multilaterals. And there's been a lot of attention recently. Many of you will have seen the the statements coming out of the Addis Financing for Development conference, also the affirmation of the Sustainable Development Goals, and obviously most of the attention there is focused in the lowest income countries. So let's have the presentation up, if we and if we could, let me move to the second slide. Okay, so what you are seeing here is there's lots of columns and lots of a line on that. So let me just explain a bit about what this data is. First of all, it's from the PPI database. It's this covers actually goes back to about 1990. I'm just showing you data from 2000 onwards up to 2014, which is our most recent update, which we released earlier this year. The line that you see represents the number of projects, and the bars represent the investment commitments in private participation projects in energy, transport, and water. I'm happy to explain a little bit more about where these numbers come from if people have questions on this. And in a nutshell, projects that are included in this database have to be in the sector. They are in emerging markets and developing economies, so we don't track the developed markets. And they have to have a minimum 25% of private ownership in the equity. So just to sort of look at both what the recent trends are and over the last 5 to 10 years, but also what we see happening right now. One thing that you will notice is quite a steady uptick in investment commitments up until 2012. And actually a big increase at and immediately after the global financial crisis. I guess we saw a lot of efforts to make sure that there was investment in infrastructure, in PPPs in key markets, including India and key markets in Latin America. What we've seen since then, though, is a considerable fall. So a big drop in from 2012 to 2013, and a modest rise from 2013 to 2014 of about 6%. I mean, there's some positives if you look at the overall total investment levels. It's and this is in real terms in 2014 dollars, just to emphasize that. Actually, 2014 was still the fourth highest. But then again, if we consider against both the targets that the global community has set itself with the SDGs, and we also consider what continued economic growth implies for infrastructure investment needs, it doesn't seem adequate. And so the big takeaway we have from this is, well, yes, there's certain levels of investment in infrastructure coming from the private sector and involving the private sector, but we're not seeing the growth that we need, trend growth that we need, that will see a substantial contribution to reducing the infrastructure deficit. Quickly, if we then look at behind these figures, one important point to note is that the activity is very highly concentrated in a few countries. It's somewhat lumpy. This depends upon often what big countries are doing with their infrastructure programs. So, for example, we saw in 2014 a lot of activity in Brazil. This was in a range of sectors. We'll come to that in a moment. But the nuts and in a nutshell, without this increase in Brazil and without the impact there, we'd actually have seen a reduction of almost 20% from 2013 to 2014. So some concerns there. Next slide, please. Then let's look at the trends by the main sectors. And so again, just to give you a quick interpretation of this graph, the first graph we saw looked at total investment commitments and broke it down by region. So now we have it broken down by sector: energy, transport, and water. So what we can see really is that energy, which is the blue bar, is consistently quite high over the years. Transport is a bit lumpier, but actually has seen fairly robust levels of investment recently. Some of that is to do with continued investment in the road sector. We're also seeing a fair bit of activity in urban transport and metro projects, for example, and rail projects. I think that's driving some of it. By far the lowest level, and this isn't surprising, is water and sewerage projects. We also know that this is probably where some of the needs are greatest. But the fact of the matter is that in most countries, the water sector is not even close to being commercially viable. Utilities themselves are, often not even properly organized, may not have good accounting systems that permit them to borrow from even domestic banks for working capital. It's not surprising that we don't see a great level of private investment coming into the water sector. There's lots of implications there, and I think I'll wrap up by addressing some of those, but there's the facts of the matter. The only bright spot is we saw a modest increase in investment in the water sector in 2014. Have the next slide. Let's turn back to some of the regional pictures that we showed you just to give you a little bit of context here. So, as I mentioned, Brazil was very prominent in 2014 and really has been a leading destination for private investment in infrastructure over the last 5 to 10 years. Actually, it wasn't the only country that had pretty robust levels of investment. So we also saw Colombia and Peru having good levels of investment, driven by a variety of sectors, some of it in transport. More generally, the Latin America region has had pretty positive levels of activity and robust levels of, I would say, investment across different sectors over the last 5 years. The acronyms that you see at the top of that graph, by the way, are the World Bank Group acronyms. So my apologies for those of you outside the bank group for being insular, but EAP is East Asia. The next one, ECA, is Europe and Central Asia, then Latin America and the Caribbean, Middle East and North Africa, South Asia, and Sub-Saharan Africa, which is AFR. One thing to note is that 4 of the 6 regions, as we define them in the bank, saw falling investment levels in 2014. Which obviously is an area of concern. Some of this is driven by reduction in activity or relative to what we've seen over the last 5 to 10 years. For example, India has not been as active the last couple of years as it was before, and that's pulling down South Asia figures. The decline in Africa that we've seen compared to the last couple of years is due in large part to reduced levels of activity in South Africa that we were recording in the renewables program and the energy program. One perhaps bright spot though to mention is we're seeing a larger number of countries active in Africa. So some activity in Ghana, Kenya, Senegal, which we think is quite promising. But again, a sort of, if we, the headline figure might be a slight increase of 7%, but looking behind that, some concerns. Next slide, please. I want to focus now on the poorer countries, the IDA countries as they're defined by the World Bank Group, and give you a little bit of a picture both in terms of overall levels and where things are going at the sectoral level. So what I have here is a graph showing the last 6 years for both project numbers and investment commitments in infrastructure projects with private participation. So a few takeaways from this. I mean, one obviously is a fair amount of volatility, but I think if you look at the total levels of investment, not surprisingly, but also it's something we need to think about in terms of both policy recommendations, but also how we meet the SDGs and the role of private finance, is that investment in IDA countries is about 7% of total PPI. Over that period, if you add all of those blocks together, that comes to 73 billion, more or less. Total global investment commitments recorded by the database for all of emerging markets, developing economies, was about 1 trillion. Also, the number of projects in IDA countries is about 10% of the number of projects in non-IDA countries. So that's obviously an issue to bear in mind. If we look at where it's going in terms of sectors, I think we see it's relatively robust in the energy sector. It's somewhat lumpy in transport and very little investment in water. If we think back to what we saw for the overall picture where water investment volumes were pretty low, it's even more so here, and perhaps not that surprising. And so one of the things we need to think about is, if we're looking to increase private investment flows into IDA countries, thinking about what it will take to get more investment into the harder sectors, and also how can we scale up what's already is low but promising in the energy sectors. If we could go to the next slide, please. A little bit of more detail on where investment is going in IDA countries by types of projects. And so here we've split it up in the database. We look at different types of projects, brownfield, we look at divestitures, we look at greenfield projects, and we look at management and lease contracts. And what we see is, and what we've compared is, the blue is the IDA countries and green is blended and non-IDA countries. And so one thing that we see is a much higher number of greenfield projects in IDA countries. This is very positive in the sense that, and perhaps not surprising, IDA countries will undoubtedly come with less of of endowment and infrastructure. It's not surprising to see the number of greenfield projects there. It also has implications, though, because in general, greenfield projects will have perhaps greater challenges in financing than brownfield ones. Brownfield projects will have some sort of track record. We may know something about the demand. There's some existing assets to build on, perhaps even existing cash flow. So that we, although it's sort of welcome to see investment going in greenfield, it also raises some challenges in terms of financing. In terms of let's now look at some of the things that are going on in terms of MDB support. So if we go to the next slide. Okay, so one thing that we've also looked at is, and this is also to understand really where our support is going, and we've included not just what the World Bank Group is doing, but also what is going on in terms of what our other multilaterals are doing. So I've got there a graph which you'll see, which is looking at both the types of MDB support in IDA countries over the last 6 years, also how it's been broken out and compared to what's going on in the non-IDA countries. So a couple of things to take away from that. One is that a welcome finding that we are more active proportionately than in IDA countries. So 22% of IDA projects received MDB support. That's about double what we see in non-IDA countries and more than double what we've seen in blended IDA blend countries. We've also seen a fairly high usage of guarantees, perhaps reflecting some of the issues about risk mitigation we were talking about earlier. Perhaps it reflects the commercial viability of the sectors. It may reflect the nature of the projects, greenfield versus brownfield, and obviously also concerns about the strength of the institutions. And in fact, one thing we looked at was we find that when the World Bank or other MDBs are involved, guarantees are employed about sort of 20% of the time for IDA and maybe about 40% for IDA blend projects. So another takeaway is a big role for the MDBs in terms of supporting risk mitigation and addressing concerns around that. Last slide in terms of IDA countries, which I think illustrates a more general challenge. So if we look back at what we've seen over the information from the database, we find that about 2/3 of IDA countries have done a project in the infrastructure sectors which has involved private participation, which is a welcome finding. Since 2009, we see that about 34 countries have done a project. I think the challenge for us, and something which I think we need to reflect on, is how one gets to scale. So although it's good that 2/3 of countries have done a project, it's actually much harder for countries to scale up and transfer lessons within a sector to do more projects and to transfer lessons across sectors. So for example, as you see in the slide, only 2 countries have done more than 10 projects, and a fairly small number of countries have done more than 5 projects. So there's clearly issues about maintaining the institutional capacity and to do PPPs. Everyone who's worked on a PPP project knows that, particularly when it's in the first in a sector, there's a huge investment in developing skills, developing an understanding of what PPPs involve, which are all needed to get the project over the line. And clearly, a fair amount of that is not being recycled and is not being used to look at where else could projects be done. I mean, obviously, we're aware that many of these countries are small and they won't be doing hundreds of projects or 50 projects, but still, it seems that the ability to scale up has not been tapped into, and that's clearly something we're going to have to address going forward. Let me step back from this then and give some thoughts about where we see things going, and also what we're doing about it in collaboration with the other MDBs. So, first of all, despite the investment levels, which have been only increased slightly from 2013 to 2014, we see that many countries continue to be interested in using PPPs. In fact, we see more countries talking about PPPs, wanting to engage with the World Bank Group in how to get their PPP program going, how to get projects started. And I think this is because of continued economic growth, continued pressure on public sector sources of financing, and an interest in seeing what can the private sector bring. At the same time, and I think this is reflected in the fact that the investment levels haven't been moving all that much, we still see a lot of unrealistic expectations. And this is really the gap between aspirations and what we see on the ground. I think policymakers in many countries still are not completely comfortable with what is needed to be done to get PPP projects over the line. This includes the risk allocation that's needed, and the risk bearing from governments. It may include some of the political economy challenges that are needed. We know the infrastructure sectors are not terribly commercially viable. There are incumbents who like to operate in a certain way. And so actually getting projects done, particularly in a new sector and where they've not done before, involves a lot of heavy lifting, and that's often underestimated. A couple of positives. We are seeing a broader range of sectors and subsectors being done as PPP. So, for example, in 2014, we saw a number of water transmission projects, so moving bulk water to municipalities that needed it. That's something that probably is relatively straightforward once water rights are taken care of and addressed. We're seeing inland waterways being developed as PPPs. So there's a gradual diffusion of across different subsectors now. So that's promising. And, we are seeing a number of countries make progress. When I was referring to what we're seeing in Africa, we are seeing a steady increase, I think, in countries that are realistically approaching PPPs, have an idea as to how these can actually be brought to market. And that's extremely welcome. A couple of other things about what we might need to see to get projects, more projects done, more private finance realized. Certainly the research we've done recently shows that the volumes of PPP projects in emerging markets correlates with institutional quality. There's overall country risk factors, but there's other things related to the legal framework, to how the sectors operate that explains why countries do better than some countries do better than others. So investing in improving the institutional quality in the countries, I think, is going to be important. That involves addressing policy frameworks, legal frameworks, institutional capacities, a lot of upstream stuff, but it does pay off. That's what we found with the limited, admittedly, but the research that's been done to date. Secondly, there's been some interesting work done by Moody's recently, some of which is now in the public domain, which has been looking at PPPs and project finance compared to regular corporate bonds. And what they find shows that if you can get projects done to the quality needed to have project finance done, and it particularly applies to PPP projects, that they have pretty low default rates and high recovery rates. So although it's a high bar, once you get to that bar, projects are pretty stable and should be attractive to investors. What we're doing, and obviously a big part of what the multilaterals are doing, is a commitment to overall financing to meet the Sustainable Development Goals. But if we look at what we're doing across the bank group, there's a broad range of activities, and that includes trying to enhance the role of risk mitigation instruments. It includes trying to expand the use of finance in in countries which haven't been doing many PPP projects before. And I think a good part of this is helping our clients to make better decisions around PPPs. So when should they do a project as a PPP or not? Do they really understand the fiscal risks that they're taking on? We think that's going to improve decision making in this sector. So one of the things we're now rolling out is a set of tools to help countries and our clients understand the fiscal risks they're taking on, and to look at, is the PPP the right thing to do in this situation? Back to Shamala. Thank you.
Thank you so much, Clive. I think the picture looks good as far as PPPs in emerging markets, and not exactly emerging markets, but more, I would say, towards the IDA countries. Numbers are increasing, countries are increasing, and it's good. And but we need to do a lot more. But let us look at what Gavin has to say about the global trends and the mature as well as the emerging markets. Over to you, Gavin.
Thank you, Shamal. It's a pleasure to be asked back again and give an update on what's been happening over the last year or so since we last spoke. I'll just give a quick overview of the area I'm intending on covering. First of all, I thought we'd just do a quick recap on what I'd said in the last presentation, and I've split it into two sections: the mature PPP markets and the emerging PPP markets. Then we'll have a look at what we think are the main developments or changes that we've seen over the last year. And then I've got an interesting case study that I'd like to share with you, which is it's a bit of a groundbreaking deal in a number of respects, but it's also indicative of the developments that we're actually seeing in the market at the moment. Right. If you look at a quick recap, and I looked at about 5 markets last time. The first one was the UK and Europe in the mature markets, and that market was basically typified by a long-dated bank debt that really covered the whole period of the concession. 29-year debt on a 30-year concession is fairly typical. It was floating rate debt hedged into fixed interest rates, and there's quite a deep and liquid swap market going out for the whole term that you would need. What was then an interesting part of the European market was specifically in the French market to drive better value for money and bring down the overall borrowing costs of associated with the project. The French had introduced something called the cession d'AI, which is a tranche of funding that's guaranteed by the state. So you'd have a tranche of funding that took full project risk, that had the full project cost of raising that borrowing, but the cession d'AI was effectively French state risk and actually had the benefit of being very low risk debt and getting the benefit of the lower pricing. Looking then quickly at the North American market, also we had long dated funding covering the whole of the concession period, reaching out to 30 years, sometimes even beyond that. But the difference with the US market is the banks are not really that active in the US market. It's really dominated by the bond market, and specifically tax exempt, tax advantaged bonds and the so-called PABs, private activity bonds. And funding a typical project in America really involves, at that particular point, trying to determine which particular source of bond financing is the most efficient. The use of bank financing in the US was typically limited to shorter dated funding, using to repay milestone payments coming in from the public sector, or sometimes as a potential bridge to the bond markets. The Australian market was fairly unique and somewhat different in that there isn't really long dated funding available in the Australian market. Everything is funded with short dated funding. The most common maturities you'll see are in the 3 to 7 year range. Occasionally you might see out to 10 years, but it's virtually impossible to get funding beyond 10 years in the Australian market. It's a fairly liquid swap market, and typically floating rate loans from the banks were hedged into fixed rate debt. We also were seeing the public sector starting to share in refinancing risk and providing some support there to lessen that. And the market was very much dominated by the Australian domestic banks and the major international project finance banks. Now, turning briefly to the emerging markets, the Indian market has continued to be very active. And as I said, then it's typified by loose structures. The project companies retaining a lot more risk than you would see in the more developed countries. And generally, there was a lot stronger support from the sponsors. The Indian sponsors were a lot more comfortable taking a lot more risk associated with the project than you would see from European or American sponsors. Generally, long-dated debt was not available. It's more in the sort of medium range. 10 to 15 years is the usual case, sometimes beyond that. Never really see anything beyond 20 years. All the debt, or pretty much all the debt, was provided by the domestic Indian banks and very much dominated by the major state-owned banks. And there's a very limited swap market in India because there isn't a common reference benchmark rate in the Indian market equivalent to LIBOR or Euribor. Each bank sets its own interest reference rate and charges the margin according to that. That interest reference rate is a single rate that the bank provides to all its customers. So it's not something that is really capable of being manipulated without affecting the entire bank customer base. The only source of swaps really is through the US dollar swap market. The South African market briefly pretty much followed the European precedents, dominated by the domestic banks, fairly happy giving long-dated funding, and generally fully hedged into fixed rate bonds. You've got a fixed rate interest payment, and you've got a fairly liquid market there. I've actually added the Philippines, although I didn't consider them last time, and I think they do merit attention. They've really quietly in the background been getting away at growing and developing their PPP market. They've got a fairly conventional risk allocation. Their process has been a little bit up and down. They've done some experimenting with transferring additional and perhaps unusual risks to the project companies, and in one notable occasion it actually destroyed the project in the sense that they didn't get any credible bids and they had to then go back and rethink their risk allocation, and they came back to the market with a more conventional risk allocation. There's a very limited swap market there, but the domestic banks are quite sophisticated. They're very liquid in both the US dollar and the local currency, and they're very keen to support the projects that are being developed in their country. Right, now we'll just turn quickly to the current market developments. And I've divided it there into the sort of the main sources of funding that we're actually seeing in the market at the moment. And looking at the bond market, first of all, the US bond market remains by far the most liquid and most sophisticated bond market globally. The interesting development is that you're actually starting to see the euro bond market develop in liquidity, in its risk appetite, and in the sort of things that the major investors in the European bond market are prepared to look at. So I think it's catching up, and I think it's a trend we're going to see continuing. Of course, a number of the major institutions that are the major investors in the US bond markets also play in the euro market, so they obviously bring that expertise across. There's also been an interesting development in India. They're starting to launch and encourage the development of a domestic bond market as a source of refinancing the mature projects in the market and to recycle the bank capital back to the new projects that are being launched. And another interesting development that actually just happened a day or two ago, the Reserve Bank of India, in its regulations, actually prevented project companies from refinancing in the offshore market for any portion of the funding that hadn't been drawn. Sorry, that had been drawn. So previously, what you would have seen with an Indian project is it would be reach financial close, fully underwritten by domestic banks, and then when they had more time, while they started the construction of the project, they would go and try and replace some of that funding with some international borrowing. But the window kept closing. As they drew down on any rupees from the Indian banks, they were not allowed to refinance that. And that's perhaps a counterintuitive regulation, because one would have thought the most obvious thing to do is have the domestic banks that are far more familiar with the local conditions refinance the project through the more risky construction phase, and then actually refinance it in the international market when it's de-risked and construction has been completed. And they've actually just changed the regulation specifically to allow that. So I think that's going to open the Indian market to a lot more involvement from international financiers. Generally, lately we've seen bond markets becoming a little bit more nervous in the wake of the jitters on the Chinese stock market, and the European bond market actually closed for a while at the height of the Greek debt crisis when they went through their elections. So the bond markets aren't as robust as the bank markets. Generally, it's very seldom you'll see the bank market actually close. Now, turning to the bank market, what we're actually seeing there is that most banks are actually very liquid and very keen to put new assets on their books. We've seen pricing come under a lot of pressure in the last year. Margins have been dropping quite substantially. And in the last couple of months, we are now actually seeing that translating into pressure on the structures. Sponsors are now not just focusing on driving the bank risk margins down, they're now actually coming and trying to increase the level of leverage, reduce the level of cover ratios, leave more risk in the project companies. And certainly from the projects that I've been involved in lately, they seem to be quite successful at that. You see the banks trying to fight back to some extent, but not with that much success. Another interesting development I saw about 2 months ago was one of the major project developers that has a number of projects on their books launched what they called a repricing. And effectively what they did is, rather than waiting for the end of the construction period when the project is de-risked and then coming to try and refinance and get better terms, typically lower margins, they actually went to all of their existing lenders, and even with projects still in the construction phase, and told them that they wanted them to reduce their margins, and said that they were approaching other banks as well to come in and replace them. That process is currently running at the moment, but from what we see, it's being run quite successfully, and they stand to with a relatively limited additional cost and inconvenience in terms of running a full refinancing thing, to make a substantial saving by getting a big reduction in their margins, even while the projects are still in the construction phase. And as a colleague of mine quipped to me, says it almost feels like 2007 all over again, and we're wondering sort of what we've learned in the interim. An exception to this, I think, is the Indian banks, and particularly the state-owned banks, who are still facing constraints with sector concentration risk, particularly on the roads and the power sector. Another increasing trend is more use of government financing. And this is, as I was explaining earlier, with the French government using the Cession d'Ailly to get a chunk of state guaranteed debt into the project, or reduce the project's overall reliance on the more expensive private sector debt. we're seeing more and more use of grant funding, where the state will put out the PPP project and not expect them to raise 100% of the debt from the private sector. They will put in a big chunk of the funding themselves. Most often you see this coming in after the construction period when the project is de-risked, but not always. There are grants that actually do come in over the entire construction period, and effectively the state coming in and taking a risk alongside the banks and equity. I did mention the UK and EIB guarantee schemes last year, and just wanted to highlight again, these schemes were actually raised at lowering the overall cost of funds and driving more value for money out of the use of PPPs rather than trying to overcome a lack of private sector funding. And what we've seen in the most recent projects in the Australian market is that they are using the grant funding to support the refinancing risk. So they will typically set a refinancing date. So if you've got a 4-year construction period, they'll say, right, year 6 or year 7, we want you to have a refinancing then, and we will pay our X million grant funding on that date. So when you actually come to market to refinance, the level of debt that you have to fund is reduced by the amount of the subsidy or grant funding that the state is paying in at that stage. They've also reducing the use of long-dated hedges. Originally in Australia, you would see a project closing with 7-year debt, but hedging the repayment profile over a 28-year period. More often, what we're seeing the states say is they will, at the refinancing date, they will reset the payment mechanism and compensate for changes in the underlying base rate, but what they're not taking is the risk of movements in the margin. That remains a risk of the private sector, who have to manage their perceived risk from their lenders. But now we'll turn then briefly to this case study, and what this actually concerned, it was the A7 motorway project in Germany. We were the financial advisors there. I wasn't personally involved in it. It was my colleagues in Europe that actually did it. It's a fairly typical European availability based road project. It's a 30-year concession period, involved a 4-year construction period of widening the A7 going north of Hamburg. Also fairly typical for the European market. They required fully committed finance at the BAFO stage. That's the second round of bidding, the best and final offer stage. And there was no market MAC protection, which is, MAC is material adverse change. So you had to have fully committed funding, and you couldn't, your lenders couldn't be let off even if there had been a change in the market. The other thing was there was a very tight timetable to reach financial close from being appointed preferred bidder. They only allowed you 10 weeks. So that meant that you had to have a very well documented transaction, and you had to have all your funders fully committed, so that there wasn't all that much to do when you actually were appointed the preferred bidder. The interesting thing on this project is those sort of criteria would normally drive this sort of a deal into the bank market. And what my colleagues did there for the first time is they actually took this transaction into the bond market. They raised 430 million of senior secured notes, and they were placed with a variety of institutional investors. With this being a sort of a pathfinder deal, we had to sort of put our name behind it quite a lot, and the bank was involved in quite a lot of functions across the whole financing. This project also included a number of milestone payments from the state, and we put in a revolving milestone bridge facility so that you could actually draw down your pay your contractor, and then at a point when the payments from the state came in, then you could repay that facility and then redraw it until the next repayment. This milestone bridge facility was also actually used for tranches on the drawing tranches on the bond funding. Another unique feature of this was that there wasn't a single drawdown upfront from the bonds. There was a deferred drawdown. You can't. It's not as flexible as typical bank funding where you can have monthly drawdowns. These were sort of quarterly or 6 monthly, and then you had the bridge facility paying your contractors monthly, and then the bond funding coming in to repay that, and then it being available for being redrawn. So just have a quick mention of what the real highlights of this this project were. It was the first project bond financing executed in the German market, and it's the largest for an A model road project. Interestingly enough, we were able to get a lot of interest from investors. Not that long ago, bond investors were very inflexible. They had their rules on the basis on which they would invest, and typically you went to them with a bond, they gave you a price, that price was available for a couple of weeks, and then you placed the bonds with them, and that was the end of the matter. What actually happened here is that at the bid stage, the bidders had to agree, sorry, the investors had to agree a fixed spread, and they had to hold that spread over the entire 6-month period to cover from bid submission through the evaluation process and right up to financial close. They weren't taking risk on the underlying reference rate. That would be set at the market rate at financial close. We also used the PBCE, which is a credit enhancement facility provided by the EIB, the Project Bond Credit Enhancement. That actually helped secure the investment grade credit rating, which bond investors require, and it did have to be modified slightly to avoid some of the adverse consequences that can flow from these facilities. But the EIB was very, very supportive in helping get this done, because a landmark transaction like this is opening up additional and potentially more efficient sources of funding. So in conclusion, it's a landmark transaction. It attracted a lot of interest from the markets, and it should act as a good precedent going forward, certainly not only in the European market. So then turning briefly, the conclusions, I think, where are we going to now? I think the trend is firmly established for the development of the bond market. I think we're just going to see the bond market showing increasing flexibility to be able to do these sort of transactions. Investors getting more and more comfortable with project risks, and with that increased appetite, there's going to come more competition from the investors to invest in these projects, and that's going to result in them showing more flexibility in terms of the basis on which they're going to be prepared to commit. However, the bond market, I think, is going to continue to be a lot more volatile than the bank market, and that's certainly been borne out by recent events in the market, as I mentioned previously, the Chinese stock market quivers and the Greek debt crisis. The bank market looks as though it's going to carry on getting increasingly aggressive. I don't see there being any stop on the lack of appetite amongst banks to carry on investing in this market, and the bond market is just going to continue to provide more and more competition to them. So in the future, I think we're going to see more bond financings, but I think banks are going to have to start playing more of the role of the bridge financing, the bridge to bond facilities, and they will continue to be the backstop financing for when the bond markets aren't closed. I think we're also going to see more and more development of the government striving for better value and trying to reduce the higher borrowing costs inherent in PPP structures. There's a number of countries that don't really sort of try to do this, and I think it's the trend that you're seeing from the UK and France and Australia is going to start spreading to other countries as well. Right, that's all from my side. Thank you very much. If there's any questions, I'm happy to try and answer them.
Thank you, Gavin. And thanks for this case on Germany. I remember the case from Germany. I remember last time we had a German banker and he was quite disappointed that we didn't have anything on the German PPP market. So that was really good. And we'll go with the question answer session now. We have very little time, but we'll extend the webinar by around 10 or 15 minutes based on, how we go. The first question is for Clive, and we'll start with the Latin American market where there seems to be a lot of interest. Javier Galera is asking, after Chile, Colombia, Peru, and Brazil, which are the most promising PPP markets in South America?
Okay, well, thank you for that question, Javier. Just very quickly, I suppose it depends on the definition of promising. Obviously, Mexico has in the past and will continue to be a potentially big market, probably a bit of activity at the subnational level. I mean, we are seeing a number of other countries interested in doing PPPs, and so, colleagues are working, for example, in Uruguay and a set of other countries in the region, also in Central America and the Caribbean. So it's a bit difficult to say, in terms of sort of volumes, that those will be large, but I think we feel that there'll be a larger number of countries doing PPP projects in the region, so in a nutshell.
Thank you, Clive. We'll come to you now, Gavin. Could you talk a little bit, this is basically a question from my side. You talked about the Indian market and you talked about the risk concentration in Indian banks. You also said that the Indian government is thinking of or working on developing the bond market. So how do you see this playing out, and what do you think like going ahead, what can they do to reduce this risk concentration? Is there, apart from waiting for the bond markets to develop and, more bond refinancing coming in, what do you see? How do you see this playing out?
I think the need for financing in the market is actually going to drive the change. You've got sponsors there that are keen to close projects. Has done a lot of infrastructure development, but it's a huge country. It's continuing to grow. It's still the fastest growing country of the major economies in the world. And as they push projects, and as sponsors are not able to rely on the traditional sources of funding, the domestic banks, or start seeing pressure and difficulty raising it, they're going to turn to alternative sources. And I think that they are then going to be amending their structures. So I think we're going to see a convergence between the looser Indian structures and the more tighter international market structures that we're perhaps more used to. But the other interesting development, I think, is the authorities, the Reserve Bank of India and the government actually starting to make changes to regulations to facilitate that. And longer term, I think you're going to see the Indian market looking like the Australian market, where typically, 1/3 to 40% of the funding on most projects is provided by the Australian domestic banks, and the majority of it is provided by the international banks. I certainly don't see the domestic banks going away. I think they're still going to continue to be the dominant players in their market, and I think international banks are certainly going to want to see them supporting the projects and going to want to be investing alongside them rather than completely displacing them.
Thank you, Gavin. Clive, the next question is for you. Zinwang asks, how do you see China's ambitious PPP initiative as it goes, as it seems more like a stimulus package for the economy?
Sure. Hello, Shin. Thanks for that question. So I think maybe to say two things on that. Firstly, that from the extent we've had engagement with the government, they're very interested in improving the way projects are done in terms of greater clarity on government support and on risk allocation. And the PPP approach is an important way of doing that. Obviously, if you look at how projects have been done in the past, they're not at that point. So I suppose the question is, to what extent will this really change the way things are done in terms of project appraisal, risk allocation, how well contracts are enforced and implemented over time. I think that's going to be the key to seeing what difference it makes. I mean, obviously, we know that in certain sectors there's already quite a substantial international presence. So, for example, the utility sector, there are a lot of international players there. One thing they do always say, though, is that they're fairly particular about which municipalities they work with, because although they have a contract, the most important thing is to have a counterparty that's financially strong and that they can trust. So the question is, what can be done to broaden the base there, to have more local governments and provinces like that are good counterparties for the contract. So I think that's a thing that will have to be worked on, and we'll have to watch over the next couple of years.
Thank you, Clive. Gavin, the next question is on bond financing again. David asks, what's the reason behind bond financing being more popular in Europe? I know we've talked quite a bit about this in the last webinar and this one too. What is it?
Well, I think the bond financing is a more natural source for long-dated funding. Certainly in the Australian market, the main attraction to them of accessing the bond markets, and a number of Australian projects have gone into the US bond market. The main attraction there is securing the longer dated funding. In the European market, it actually tends to be cheaper than bank financing, and these are all competitive processes. And the common thread I drew out of the different funding structures that you see in different markets from my previous presentation is effectively the private sector being incentivized to come up with the cheapest, most efficient overall funding that they can, to be as competitive as they can and obviously win the project.
Yeah, sorry about that. I'm trying to find this question on metros. Vijay Kumar asks, what is the global experience with urban metro transport projects in PPP mode? In India, it's often said that EPC is a better option for metro rail projects. Right.
Well, I don't want to try to give a definitive answer on this. I mean, obviously, we know that metro projects are going to have to rely on a substantial amount of resources coming in from outside of the fair ridership. There have been a number of structures which have used real estate to prop that up. Obviously, also the government co-funding alongside the private sector. I mean, to the extent we've seen, and the bank has done some work on this in the past, and we're actually doing some more work looking at the role of the private sector. It's possible to have good outcomes, and in fact, perhaps a better service delivery performance because you've got more accountability under the contract. But I think it's important, as you flagged, to look at this on a case-by-case basis. So, it would not surprise me that in many cases you might want to go predominantly with a public sector funded and perhaps implemented option. So it's something which, and also bearing in mind that cities are all very different, and the solutions may also differ. So I think it's difficult to give a definitive answer. I think if people were saying that EPC is always better, I would disagree with that. But would also caution to make sure that the right role for the private sector is established, right risk allocation is put in there, and that governments intending to do metros understand that and make decisions accordingly on what the role of the private sector is.
Thank you, Clive. And we have two questions, two very interesting questions from Diana Klein. And she's asking, do we have any successful projects in Iraq? And then there's this question on how are we able to access sample contracts and track project operations in best practice. So before going back to our speakers, I'll try to answer these. This is what we're trying to work on, accessing sample contracts and track project operations. We've done some review from the World Bank on this, and we find that some of the countries are putting out not just sample contracts, but they are putting out real contracts. So you could go to their website and try to find these. And we have a PPP IRC website where you can see a lot of the sample contracts from different countries. So do please go to that World Bank Group website and try to look at these. And tracking project operations is more of a problem, and we've seen that there's very little project information out there, and this is an area for a lot of future work. In terms of successful projects in Iraq, Iraq has had, there's this security risk and other problems going on there, and have been there for a long time, but Iraq does have some private participation. They're also trying to look at private participation in electricity, specifically in the distribution sector as well as the generation sector. So we'll see something going on in the next few months and years, probably. So keep looking at this space, and maybe at some point we might try to have some discussion on this. And next week, for your information, we will be having Munir Firozi from the International Finance Corporation talking about PPPs in the MENA region, that is the Middle East and North Africa region. Going back to our speakers, Gavin, there's a question from Monica, and she asks, what do you think is the role of pension funds in order to invest in PPP projects? Do they need special policies? You touched upon this a little bit, and you talked about institutional investors. So what kind of policies do these investors need themselves in order to be able to invest in projects? I know there are problems of what kind of projects they can invest in, and what kind of rating do these need before they can invest. So those were problems we saw in some of the countries. Could you talk a little bit more in detail on this?
Yes, certainly. It's not really my field of expertise, but obviously for good reason, pension funds are very highly regulated. Shamal, as you rightly pointed out, in terms of the type of assets they're allowed to invest in, the quantums that they're allowed to put in, what sort of ratings the assets have to have, and the problem with projects is that you have long dated bond issues or debt instruments that tend to be fairly illiquid. So if you're a pension fund and you invest in the project debt, and something goes wrong in the project and it gets downgraded, and you may actually not be allowed to hold that anymore because it doesn't meet your rating criteria. So I think what needs to be done is you infrastructure in terms of pension regulation, I think needs to be identified as a specific asset class that pension funds are allowed to put even a relatively small percentage of their funds into, and that if it is in that portfolio, it's exempt from these sort of regulations in terms of minimum ratings and that sort of thing, and that they can manage that portfolio differently so that in the overall portfolio they're not taking too much risk on out of line with their normal regulations, but it would certainly be a substantial amount that could be set aside for projects. I think generally the pension funds and institutional investors are getting to understand the nature of the risks and how stable the cash flows are on these type of assets. And of course, as they get comfortable and want to invest in them and find them as attractive investments, they in turn should be putting pressure on the regulators and getting the regulators comfortable with the nature of investing in infrastructure assets. Sadly, of course, these things are slow processes.
There's a question about DFID and its role in the PPP market, and that's from Javier again, and that's for Clive.
Okay, so this, I guess, is also related to us me presenting the information on the multilateral development banks. Certainly, the bilateral organizations like DFID are playing an important role in parts of the world. They're very active in sub-Saharan Africa, which I see as a priority, for example. They do a lot of work in the upstream enabling environment, but DFID and a few other bilaterals have also been supporting financing through the Private Infrastructure Development Group, PIDGE, and a few initiatives which that has. Obviously, the resources aren't the scale of what the multilateral banks have on the table. But they're an important partner of ours, and they support a number of facilities we have. For example, the Public-Private Infrastructure Advisory Facility. DFID is a very strong supporter, as are a number of other of the bilateral aid agencies. So particularly in the enabling environment, I would say. Also maybe looking at projects which are in water and sanitation and for lower income communities, for example, through the Global Partnership on Output-Based Aid.
Thank you, Clive. There's a question on the trends in PPP projects in Sub-Saharan Africa region. I would ask both of you to speak a little bit on this. I know, Clive, you touched on this, and you spoke about how more countries are now doing PPPs in Sub-Saharan Africa. Could you please touch on this, and we go briefly, and then we go on to
Sure.
Gavin.
So very quickly, obviously, if you're looking at total volumes, South Africa would be, hugely important. So, but I think the question is also trying to look at what are other countries doing, and two things. I would say, from looking at the type of dialogue and support that the World Bank is doing in that region, we see more countries interested in doing PPP. So we actually see more countries actually going from aspiration to an ambition to actually realizing projects. And there are some countries which have got a reasonable track record now. For example, Kenya in the power sector. Ghana has just recently done a big energy deal. I mean, obviously, that's some aspects of that are not what we want to define necessarily as PPPs. But we think that there's a broader base of countries interested in this. We do also think that in many countries we are looking at roles in the private sector which often don't involve a great deal of financing, particularly for the lower income countries. That's going to be important, management contracts and leases. So, a fairly sort of broad range of activity and a fair bit of progress, I'd say.
Thanks, Clive. And Gavin, could you touch briefly on this, and specifically on what we talked about in your last webinar? And this was about, the risk and the political risk, and the way the investors ask for the guarantees, which are basically letters of support in all of these power projects and most of the new projects coming up. So what do you see happening in terms of this going forward in Sub-Saharan Africa?
Yeah, I'm sorry. I don't cover the African market anymore since I transferred to Hong Kong. So I'm not really up to speed with the specifics of the latest developments, but certainly are seeing more countries take an interest in it and seeing more and more deal flow coming out of there. I think the main source of funding is you're going to have there is going to be the development financing and funding from local banks. Now, the difficulty that international banks have with lending into most sub-Saharan African countries is their relatively low credit ratings, and that limits the appetite of international banks for those sort of risks. But it particularly affects projects where you need longer dated funding. So in those markets, typically, at this stage, you're only really seeing the international banks being involved in sub 12-month maturities, which is typically trade financing, and they're not really able to play in a role in the project financing. And that's what I'm actually seeing here in the Asian market with some of the more lower rated countries, but Bangladesh, we certainly seeing is coming along. They've got a very sensible and well-run PPP unit, and they structuring their projects well, but still battling to actually raise the funding for them. But it's the start of a trend, and I think those sort of trends will pick up momentum. And certainly, if Bangladesh can do these things and get over their difficulties, so can sub-Saharan African countries.
Thank you, Gavin. Yeah, I would agree about Bangladesh. If you remember, we had a speaker from Bangladesh, the head of the unit last time, and I would urge people to look at that webinar again. And now we have come to the end of this webinar today, and I would urge everyone to log in next week, same time, Tuesday, to hear about project financing and PPP financing basically in the Middle East and North Africa region. Thank you all for joining us today, and a special thanks to Gavin and to Clive for being there and for making this a very interesting webinar. Thank you so much.